approach the audit engagement. So what we're going to move into now and going forward is talking about the audit engagement. The auditor, how they prepare to audit the engagement, what are the things that they do in the engagement in terms of collecting audit evidence. So now we're kind of getting into the second standard, right, or the principles related to the performance of the audit, right, the standards around the performance of the audit. And so we're going to start out by talking about engagement planning, right? So we have to, of course, the auditor has to plan, because if you don't plan, then you have no idea what your needs are for that audit, how to staff that audit, what to expect. You won't be able to effectively assess the risk of material misstatement. So we start out by talking about the auditor's responsibility with planning and why that's important. So obviously, right, you want to avoid misunderstandings with the client, for one thing. You want to obtain sufficient and appropriate audit evidence, and remember, sufficient audit evidence deals with the amount of evidence that's collected, so the extent of audit evidence, whereas the appropriateness or competence of the audit evidence deals with relevance and reliability. If the audit evidence is relevant and reliable, you want to obviously keep audit costs low, because that's always a source of contention between with the client is how much they pay for the audit. So we know engagement planning is important. And so what we're going to cover in terms of in the next couple weeks or so is talk about, or in this today and possibly Tuesday, is what is it that auditors do when they're planning the engagement? What's important during this phase of the audit? And so we're going to focus on accepting the client and performing their initial audit planning process, understanding the client's business and industry, assessing client business risk, and performing preliminary audit procedures, analytical procedures. And I'll talk about the distinction between why preliminary analytical procedures are important at this stage, even though it can be performed throughout the audit. And then over the next few weeks, upcoming weeks after the first exam, we'll talk more about assessing audit risk, materiality, fraud risk, and internal controls. So the pre-engagement activities involves the auditor assessing whether or not they're going to accept the client or retain the client. Do they want to continue to audit a particular engagement? And which seems counter, right? That why would an auditor be willing to give up audit revenue, right? So why would they audit a client? Well, there could be a number of reasons, right? Maybe the client is not the type of client that they want to continue to be associated with, right? If there's integrity issues around the client, they might not want to be associated with that client. If it's a very high-risk client and they're not willing, the auditor is not willing to absorb that risk, because if it's a high-risk client, that means that the auditor's risk increases, their engagement risk increases. So if it's a client that there's a high possibility of potential for litigation, or management lacks integrity, or whatever, then that exposes the auditor. And so after Enron and WorldCom, right? So audit firms got a lot more clients, right? Because Arthur Andersen went out of business. And the remaining firms, those clients had to go somewhere, and they dispersed amongst the remaining firms. But also, what happened after Enron and WorldCom was Sarbanes-Oxley, right? So remember, initially with Sarbanes-Oxley, that was the initial phase of initial time that auditors were mandated to provide an opinion on internal controls. So they had to audit internal controls, and that created a steady stream of work for auditors, because for publicly held companies, this added additional audit work because a lot of clients weren't prepared to have their internal controls audited, because they never had to worry about that, because it was never an opinion issued on internal controls, so they never really had to worry about that. And so I remember at the time, one of the partners, I can't remember which firm, but one of the partners talked about the fact that they started shedding clients. And the reason that they felt like they could shed those clients, one was because they were higher risk clients. And a lot of times they tended to be mid-sized to smaller clients, not no one's firms were walking away from their really big clients, but these clients are too high risk and we're not willing, and we're okay shedding ourselves of these types of clients because, we're getting the revenue from somewhere else. So it's not like they took this huge revenue hit, right? So they got rid of higher risk clients and to shed some of their risk and exposure, especially after where we were coming off of the Enron and WorldCom scandals. So auditors do assess, and their quality control standards require the firm to assess whether or not they want to retain a client, right? And obviously for new clients, they want to go out before they associate themselves with their client. They want to make sure that this is a client that they want to be affiliated with. And so these procedures, obviously if it's a new client, the procedures are going to be more extensive than if you're looking at retaining a client, because if you're retaining a client, you already have information. One of the key things with when they accept a new client is the standards require that they communicate with the predecessor auditors, right? And that's really to find out information. And the standards require them to attempt to communicate. There's no requirement for the predecessor auditors to communicate, right? If they choose not to share information with the new client, the new auditors, they're not compelled to do so.
Is that common?
Common that they don't. I don't know. I don't have my limited experience whenever. I think in all the time that I was in, only once was I on a client that we lost a client, and we cooperated with the predecessor auditors. And the other time we lost, I was on the other side of it. So we cooperated. So I would imagine because of professional courtesy that firms would cooperate with one another as opposed to not. It's just what extent of information they're willing to share. The other thing is the client has to approve it. Right? So the client, because unless the client approves it, that predecessor auditor is not going to provide information, because remember, auditors have an expectation of confidentiality. Even after they lose the client, they have to protect the client's information, confidentiality. The other thing is auditors, and we talked about independence and ethical requirements already, but auditors, through their quality control standards, have to ensure that they're complying with independence rules. And so we talked about the fact that most firms are looking at independence on a regular basis. So, and then engagement letters. And engagement letters are really the contract between the auditor and the client, right? So it spells out what the auditor's responsibilities are and what the client's responsibilities are. So if there are things like deadlines or schedules that the client has to provide or promises to provide the auditor in a time period, they do that. Right? If the client says, okay, we need this audit signed off by X date, or we're doing this audit for, right? Then those are the types of things that are included in the engagement letter. So again, to just summarize, with the communications with the predecessor auditors, basically, they are trying to determine the integrity of management. Right? They're going to ask questions. And it's and they can say, right? So what if the client says, or the predecessor auditor says, we resigned because we weren't happy with management. They always fought us on things, and so we were concerned about integrity, and we decided we don't want to be associated with that. That doesn't prevent the new auditor from accepting the client, right? There's nothing that says you can't accept the client that you doubt their integrity. What do you think the auditor would do if they accepted the client? How might they protect themselves in that situation?
Staying true to their guidelines as an auditor, even a fair evaluation. If they see that it's not good,
Right. So in other words, not the prospective auditor, but the new auditor, right? So let's say the prospective auditor says, yeah, this client has issues with their, they weren't always upfront with us, and we questioned their integrity. And the new auditor said, hey, okay, but we're gonna accept this client. How do you think they approach it?
Maybe hire auditors to make sure, to deal with like the risk involved.
Like they have higher risk. Like at that point you have higher risk. And so maybe they try to get like, we're gonna charge higher audit fees. But if they don't, what's the other way that they should be doing anyway? What did we just talk about, terms and characteristics?
Contract? Enforce the contract?
Well, no, that's the engagement letter, right? You're gonna enforce that anyway. But no, in terms of the auditor, independence and maintain their independence in Shannon.
Oh, I was gonna say higher level of skepticism.
High level of skepticism and maintain their independence in what? Remember the two different aspects of independence. Right, mental attitude, right? They're gonna have to be mindful. Judgment is gonna be really important, right? So they're gonna approach the audit with they should approach the audit with a question in mind and skepticism anyway. But in those situations, it's even more, they have to be more diligent about it. So there's nothing that prevents them from accepting the client. Now, prudently, they might not, right? They have to weigh the risk and rewards of accepting that client. They want to know disagreements about any accounting principles or, because for a publicly held company, the only thing you have when there's a new auditor is that the company files an 8K saying they switched auditors. That's it. There's no explanation of why. So that's why this communication becomes important, so that the new auditors can get more information about it. And just communications about whether or not there was anything going on that concerned the predecessor auditors as to why they left. Most times, they might just say, and they do, sometimes predecessor auditors will, if the audit firm requests that they look at the work paper, sometimes they'll allow them to do that. But they will do it very, they've already gone through and scrubbed the papers and taken out, information that they don't want to share, and they really monitor what information they give the current auditor. We talked about the importance of independence, so I won't spend a lot of time talking about that, but again, it's the auditor's responsibility to ensure that they met the requirements of independence and maintain independence, not only from independence in appearance, but also independence in mental attitude, and understand the implications of impairing their independence. As I said, yes, Stephanie.
So the client has to give approval if information is shared between the predecessor and the current, but do they have to, why is it required that the current one contact the predecessor?
Because you should be getting, for those, let me just go back a minute. The reason why is because when an auditor leaves, right, or you don't know if that auditor was fired by the client or the auditor decided to resign, and what were the circumstances around it. So when a new auditor is determining, okay, I've accepted this client, or I'm looking to bid on this client. Usually they've accepted it by the time they contact the predecessor auditor. They want to know, are there concerns? Why did you leave? What were the circumstances around it? Are there any issues? Because these types of things most times are not going to be publicly available information. So it gives them a sense, are there any particular, for example, are there any particular accounting issues because that we should be mindful of and aware of that could result in lead to a material misstatement, so that it helps the auditor in their planning process. I think to help them be able to better identify where some risks are, and then also things like integrity of the management, because audit firms will go through, they have their own process for investigating clients, getting recommendations from people in the business community that's done business with that particular client, because they really don't want to walk into a situation that could blow up, right? So they're trying to manage, because the audit firms, right, their client list is, they manage their client, the risk, just like if we are investing in different companies or in a mutual fund, we try to diversify our risk, right? We're not going to go with all risky investments, right? We're going to try to diversify our risk, and that's what they're trying to do as well. They want to diversify their clients, or their portfolio, in terms of the generation of revenue. So they're trying to diversify that. So they want to try to manage that. So they try to find out as much information as they can to help them, make the right decision, because they don't want to there's no guarantee, but you want to try to be as knowledgeable as you can about because the engagement risk that this client presents to you. Because the engagement risk, which is different from audit risk, right? Audit risk is the risk that you blow the opinion. Engagement risk is the risk you have being affiliated with that client. And so there's some things that are just based on the nature of the client. It's a publicly held client. So if you have a publicly held client, that increases the engagement risk. Not the risk of material statement, just increases the engagement risk. Because there are more people, that the report is dispersed amongst a lot more people, and you have no idea how the report is being used, right? So that increases your engagement risk. But also being involved with a client that has, issues and problems, whether it's from an integrity standpoint or they have regulatory issues, that also increases the auditor's engagement. So they're looking to manage their engagement. Yes, Shannon.
So you need a client's permission for every single topic that you're going to talk about with the.
Well, you need you need the client to approve you speaking with them.
In general with them.
Right, and also the predecessor auditor has to have permission to share client information, which shouldn't be a problem. If you're hiring an audit firm, they're going to see the information anyway.
Yeah.
But that because of the standards, right? The auditors are bound by confidentiality rules, and so before that, a predecessor auditor can release any client information to the new auditors, they have to have permission of the client. So, in terms of the planning process, so this is that you've accepted a client or it's an existing client, the auditor is going to perform their initial planning to assess the client's risk, right? Assess the client's business risk to understand the client, right? Understand the client's risk in the industry. And so the steps of the audit, because remember, the second standard of field work, sufficient understanding of the entity. The auditor has to have a sufficient understanding of the entity. So these are some of the steps that things that they're going to look at. Understanding the client's business and the client's industry. Right, and then obviously I think we understand why you need to understand the client's business, right? But you also want to understand the industry, because you want to. One of the things that we're going to talk about in a moment is analytical procedures, for example. So what's going on in the industry, and how does the client measure up against it? If you see, for example, that the client in current year, the client's revenue has dipped, gone down, or decreased. A lot. How are they doing against industry? Well, maybe it's not such a huge problem if you're seeing an overall dip in revenues for the industry, right? And so it's more of an industry issue possibly than it is a client issue. Not that you want the revenue going down is good, but it's something that's impacted the industry across the board. So maybe it's more of a macroeconomic issue as opposed to an issue that's relevant to that particular client. Right? The other thing is understanding accounting norms for that, because there's some industries where GAAP allows a departure, so there are industry financial reporting standards, right? For certain things, right? There's certain areas that are unique to a particular industry. So you'll have an industry, the reporting of those transactions or those events are driven by industry standards that are obviously approved under GAAP, right, or under the SEC. So knowing the industry is important, but also knowing how your client stacks up against its industry peers is a common analytical procedure that auditors will perform. If your client's revenue is growing and the industry, all industry indicators indicate otherwise, and the industry, all their peers are going down, and the macroeconomic environment suggests that theirs should be going down, that might raise a red flag to the auditor, like, okay, why you're going this way and everybody else is going in the other direction? Not that the client is doing anything, but it certainly raises a red flag. The other thing is understanding the external environment. Right, so what is going, so we saw like in 2008, because we were going through a recession, right? The financial crisis hit, certain segments of the market were hit even harder. Certain areas of the country were hit even harder. So housing prices were depressed. In some areas they were more depressed than others, right? So those are all that's the external environment, which has nothing to do with the client, right? There's nothing the client can do. At that point, they're impacted, like all of us, we're impacted by the financial crisis, right? And so if you were, let's say, Home Depot and Lowe's, well, if the housing market was going down and building, you didn't see a lot of construction, well, of course, then you would expect to see that a store like Home Depot and Lowe's are going to feel that, right? You're going to see their revenues decrease. The other thing is you're going to look at it by business operations. Right? So if you look at it by segment, you break it down by segment, areas of the country, you can see what areas of the country were really dragging revenue down. Like there was, obviously we know that there were some areas of the country that were hard to hit. So that's why it's important to understand the external environment, because it helps explain some of the anomaly or the changes in your client's financial picture that you see as you're going through the current, and it helps you to think through, well, where's the risk. So for example, let's take the example with Home Depot and Lowe's. And so the housing crisis, right? People aren't building as much as they were. Construction was hard hit by it. So so other than revenue, what's another impact of that, and that you would see in the financials, the company's operations? What's the other side of that?
The expensive portion of it?
Well, expenses in what way? Give me an
Like-
example.
I don't know, overstatement, understatement of expenses.
So you're saying that they're intentional, but so you're saying that there could be an intentional managing the numbers. But aside from intentional, let's just say just straight economic effect of not generating where your revenues are. You're not generating the same revenue. You're taking a huge hit.
Layoffs, maybe, because that's indirectly impacting revenues, because if each team is working on a project and, say the 2008 financial crisis happens and you had to lay them off, that's projects that aren't being done.
Okay.
Like you write off more goods that weren't sold.
Right. Inventory. Because you're not selling. Right? And so, you would like to think, so you would see higher inventory. That would be the expectation because you're not selling it. And so when you think about a store like Home Depot, I don't know, they're probably not, I'm trying to, what would be subjected to inventory obsolete? So you might have slow moving inventory, but I don't know what would necessarily become obsolete, like, because I'm trying to think of what they sell.
Like plants or something?
Plants, like, plants because they're gonna die, nobody buy them. What did you say there?
And maybe paint.
Paint, right, so yeah, so there'll be certain inventory items, right, that you might see where they're slow moving, and so that they don't have any value, they're not as fresh, right? So you're gonna see that, right? You see higher inventory levels, but then in certain areas you might see inventory that's subject to valuation issues, right? That would necessarily, maybe there are higher write-offs, things like that. So, that's the kinds of relationships, right, that auditors are gonna look at and say, okay, revenues are down, what are some of the possible effects of that, right? That revenue, that we know that there's a financial crisis and that's driving revenues down. What are some of the other implications that we would see in the financial statements that explain what's going on? And that might force auditors to look, it's like, okay, we need to take a longer look at, a more more detailed look at inventory valuation because of that. Layoffs would be another thing. So when you lay off, you set up reserves, right? Probably reserve set up. So that creates another area that under really good economic times, it probably wasn't an issue for that company. So looking at their external environment, looking at their business operations, another important area is management and governance, right? Especially when you're, a multinational firm, right? You have a lot of moving parts. How does management ensure, on how do they govern? What's the role of the board of directors? What's the role of the audit committee? Right? How effective are those? Are there proper segregation of duties? Like are there any individuals who have, especially in privately held companies or smaller companies, is there any one individual who just seems to exert a whole lot of control? So what kind of environment do they have? And how might that impact the financial statement? So you can imagine if you have a company where there's one individual who exerts a significant amount of control, that might manifest itself in internal controls, right? That internal controls are not adhered to or they're overridden.
Touching on that, maybe it's part of Sargent's absence, but people who have like significant control over something that they're like forced to take 2 weeks.
Oh, you're talking, yes, that in the financial, yeah.
Public companies, obviously.
Right, and that is the case with financial services companies too, right? That you have to take a 2-week vacation, like it's not negotiable.
Right, they can like look into like regulators.
Right,
into,
it's
emails.
right, it's regulated, right? That you can't have the company can't call you at home or wherever you are. You can log into your email. You're not doing any type of company business, and the regulators check that.
Yeah, and it's supposed to like make sure that the company can, like that they still do what they're supposed to do with or without.
Right. And that's a big fraud detector as well. What indicate, right? So if a person never takes vacation, that raises a red flag, because I can't imagine anybody who does not want to take a vacation. Even if you take a vacation and never leave your house or just hang out on your whatever, you want those weeks away from work. And so usually that is when we talk about fraud, we'll talk about it a little bit more, but that's an indicator of like, is this person doing something that they shouldn't be doing? But in the financial services, you have to take for 2 weeks away. It has to be a straight 2 weeks. You can't take a week here and a week there. And the reason for that being that if you are doing something that you're not supposed to be doing, then it's likely to be uncovered in that time period, because the work that you do still has to be done. Right? And so somebody else is going to step in and take it, and it's more likely that it'll be uncovered if there's not guaranteed, but if a fraud is being committed. So that's what. And then the last 2 things are looking at the company's objectives and strategies. And you might say, well, how might that impact the financial statements? What you're really looking for there, right, is companies set these objectives. They set these bars that, okay, we want to grow revenue by X, or we want to increase our earnings per share, our net income, or what. So they set these objectives. They have these strategies to reach them. And what if they're not? So looking at where are they in terms of being in line with what their goals and objectives are, their strategies. What strategies do they have in place? So another example might be, what if you have a company that has products that are patent, right? And they have products coming off patent, right, that's soon. So what kind of strategy do they have in place to address those? Because your concern is how might it manifest in the financial statement. So let's just say, for example, a company has a product that's coming off patent. Well, what happens is your revenue can take a huge hit, because you no longer have the sole right to sell that product, and so now it's other companies can sell that product, right? Maybe they can sell it at a cheaper price, and so your revenues or it just creates competition, and so now your revenues can take a hit. What strategy does the company have in place to address that lost revenue source? And because what you're concerned about is that if a company, especially if it's a publicly held company that's followed by analysts, if they lose that revenue and they don't have a strategy in place to replace that revenue, or at least the portion of that revenue, how might the capital markets react? Right? Because if they're not replacing that revenue, then their net income's gonna go down. And we know the market reacts. They wanna see your revenue like this. They don't want it going down. It could go here, but they don't want it going down. But because they penalize you, don't penalize the company in terms of their stock, right? And so then, does that create incentives for management to manage earnings? So that provides the auditors with some information when they consider the totality of things. And then finally, what kind of measurement and performance structures